In the fifth problem from the worksheet, we have a variation of the exercise before it. We have the same facts. Instead of selling the receivables without recourse, however, the sale is with recourse, meaning that if the account receivable is uncollectible, the company is going to have to make good on the uncollectible receivables. So our fact pattern is the same, the agreement between the company and the bank, except that now we anticipate that $4,000 of the factored receivables will be uncollected, therefore an obligation exists. Well, when an obligation exists, that means we have what? We have a liability. So we're going to have to, in addition to our prior entries, recognize this liability. And from our account list here, the most appropriate account name would be liability for uncollectible factored accounts, and that's a total of $4,000. Just like in the prior exercise, the bank gave the company 90% of the face amount of the receivables in cash up front, so the company received $90,000 in cash and gave up rights to $100,000 in receivables. The bank has agreed that it will retain the 10% and it will remit back to the company any funds that it collects up to a total of $100,000, and they will extract from this remittance their fee of 1%. So again, we have a future receivable. We anticipate that we will collect more than the $90,000. In fact, we anticipate that we will collect an additional $7,000 that is in that 10% retainage. So we have a future collectible, finance receivable. Its value is going to be the fair value of $7,000 that we have estimated, minus the bank's fee, which is 1% of the original factored amount of $100,000. So we anticipate down the road receiving an additional $6,000 from the bank. We also believe we have this liability is the anticipated amount that will not be collected on the receivable, and we will have to make it up to the bank. Notice that the cash plus the finance receivable plus the liability equals $100,000. So we're responsible for the $4,000 that will not be collected. So in order to balance this now, we have $96,000 in debits. We have credits of $104. We need a debit of $8,000. And again, this $8,000 represents the difference between the asset plus that we've given up plus the liability we're assuming, less the assets that have been received. And that's pretty much the definition of a loss. So that's our journal entry. The difference here being, since we are responsible or have an obligation for the $4,000 which will not be collected, our loss will increase from $4,000 to $8,000.